Welcome back to another trading show here with Josh and Scott. I need to get the disclaimer out of the way before we move on much further in here. This training is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. I want to draw your attention to the last sentence, underlined as if to suggest importance. Any results shared with you should not be considered typical. We'll always talk about our actual trades, our real money accounts, but I don't want you to mistake and think that a 60-minute YouTube show is going to replace years of study, research, and practice. Have we all communicated? We're getting a little bit of a late start today. I'm seeing people get logged in here. I had a complete brain fart, and we didn't get the show scheduled. So I think a lot of you guys are used to that notification popping up and letting you know that it's coming up. So we'll probably get some people joining us here a little bit later, but I don't want to delay. If you're joining us as we go forward here, you can always rewind and go back to the beginning and see what you missed. But we've got a lot to talk about with the Fed report that came out yesterday. Of course, this is Scott's jam. He can hit those suckers out of the park. And before I turn it over to him, because I think I started with him last week, I'm gonna jump in here. Which, by the way, I don't want to add a lot of color and details. You know, it's weird enough y'all are like in all of our business anyway. But Scott's had a tough week, my friends. And Scott, I'm so grateful you're here. Our prayers are with you. We don't have to elaborate on it, brother, but it means a lot to me that you would show up here in the midst of everything that you're dealing with. So thank you very much.
Appreciate that.
Let's talk about stock market-y things here. I need to move some faces around. I'm going to get a template together here that we don't cover it up when we go to the screens and you guys see the charts, which, by the way, those of you that are kind of OG TradeSmart members, can I have a round of applause for the upgrade in technology here, where we're not just dependent on Zoom and the catastrophe that is with resolution and being able to see. My charts, at least as I see them, are so much clearer on YouTube, so we can actually see some details that we're looking at. This is what I wanted to point out as we get started here. We've hammered, and by we, I mean me, because it's one of my favorite things to do. We've been talking about these Fibonacci zones. You can go back many YouTube recordings and see us put these boxes on here in real time. You know, everybody's a stock market genius in hindsight. It takes a real stock market pro to do quality market forecasting that leads you to making a decision for the type of trade that you want to place. And we've been watching this red box here for quite some time. And the way that we established that range right here. And we kind of had a debate about which candlestick we could use. Do we want to come up here and grab these lows from these candlesticks? Or we had this one outlier down here. That was the inflation report. And we gapped down and we had the mother of all bullish engulfing patterns on that day. And I kind of like that candle because it was a definitive moment in the market where it said, nope, we're going here. And then the buyers came in and said, nope, we're going there. And that's what we're looking for with fibs is we're identifying this framework in the grid. We want to know where these spots occur that the market makes a definitive change in direction. Keep that in your mind. In fact, I'm going to mark this with a flag because we're going to come back to this here in just a second and use this information going forward. And so what we had said last week, the weeks before, so many weeks before, as long as we trade to or within but not above this red box, then we're still in a demonstrably bearish trend. And I use languaging a little different than Scott, and that's okay. We can all be friends and learn from each other. But in my model of the world, what this means is I must maintain a bearish bias. I must consider that the direction of the stock market river, the stream, if you will, is heading from north to south, from high to low. It's bearish. And so it's not to say that I don't ever take a bullish trade, and I did yesterday. I'll tell you about a trade that we took yesterday for the Fed report, which worked out very nicely. But it's just saying, like, hey, pay attention here. We might not go up forever. And indeed, we shot up. And then the Fed report yesterday, we just cratered like a lead balloon. And I'll let Scott talk about the Fed here in just a second. But where I want to go to is this, because it's very interesting movement right now on the market. If we do the inverse of this, so we were just figuring out, let me get a different color other than blue here so y'all can see it. There we go, magenta. We're saying, okay, if we're heading in a downtrend, we pop up, how far might we go until we're expecting to go on lower? The inverse of that, whoa, I got Fibonacci lines everywhere. The inverse of that could be true as well. Like, just imagine we were kind of coming up here and we were looking at the current move, the last 3 days, as a pullback, and we're thinking, oh, maybe it's a good time to get in and go bullish. How might we know where that bottom is? And the answer to that quandary is we measure this range here, and we say as long as we trade a certain way into that range, but not beyond, then we must maintain a bullish framework. And the way that you do that is with these fibs. We come back here, measure on down to the bottom of this candlestick, and I think I moved this box. No, maybe I didn't. Let me see here. What is changing on me? I must have moved this box because, or it was an old box before we got up higher. Yes, that was it. Here we were. So if we come back up to here, let's put our box on here. Sorry, that was from last week before we made a new high and updated it. That would be our box that we're sitting in right now. But here's what's interesting. This candlestick obviously worked well for this range up here, but the other ones worked better. Let me go back to that. Put your eyes in the red box here for a second and keep an eye on where this price action is. If we picked these candlesticks, this black one here, this white wick that came down and bounced, other than this one outlier, there's a lot of support, a lot of congestion that happened in there. And if we measure off from that, back up to our OG range here, look how closely price action lines up there. We might even be able to tweak this a little bit and get it perfectly. Boom. That, for those that can't see, are these candlesticks right here and awfully close to this one here. Let me see if I can tighten it up just a little more because my OCD is kicking in. I don't actually have OCD. That's not to make light of people that do. All right, pretty close. Arguably closer than the red box was. So I'm also going to mark that as well. Both were beneficial to us. Actually, it's probably this candlestick right here. But here's what's cool. We just measured back to the big white candle right there, and we got the green box. But what if I adjust that measurement up to here? Y'all see what's happening? We just got a confluence zone, and I mark that with an orange line. Orange in my model of the world, unless I've made a mistake and had a brain fart, orange is always confluence for me. That's where, and usually confluence with fibs, where multiple things are lining up on top of each other. Call, the 50% way in the fibs box, whatever you want. By the way, it's 11:11, so use this time to pray for somebody you love. It's just a thing I've always done my whole life. And we're bouncing with a hammer candlestick right here at the Fibonacci support zone. So let me tell you a little bit about how I traded these last 2 days, and then I'll hand it to Scott. And I apologize, I've talked ad nauseum here. Y'all doing good? I see lots of thumbs ups coming and people watching and stuff, so we must be adding value here. So the market was sitting right around in here at the Fed announcement yesterday. Let's go into a 15-minute chart here, and I'll show you exactly how we traded this. Now, many of you are in the new trading room that we just launched with TSU. It's a hoot in there. We were in there all day live trading this as it went on through. So right here is where the Fed announcement came out. And right about here, I bought a strangle. So with options, that means I bought a call and I bought a put. And the idea on a strangle is, it goes one direction and one side makes money, the other side loses money. And the IV, the implied volatility, was low enough and the bid-ask spread was tight enough that I thought, all right, I'm going to try this. And fun fact, it's my first strangle that I've done, first options trade that I've done since COVID hit. And so what happened was at 2 o'clock Eastern right here, is that the 2 o'clock bar? Yep. The Fed report came out, and everybody thought, oh, wow, they're becoming dovish. They're going to start relaxing their monstrous foot that they've had on the economic brakes, and everything is great. And then at 2:30, which is the start candle here, Fed Chairman Powell started speaking, and he was like, well, that's kind of true, but we've not really seen any improvement in inflation, and we're not committing to easing off any of the interest rate increases. And the market was like, nee. That's a Monty Python reference for those that are unfamiliar. And so what I did here, we were kind of masterminding this in the trading room. I held the calls all the way up to here, and I just about top ticked it. That's just an issue of pride for me. All right, I sold my calls right here, but I held on to my puts. And the reason that I held on to my puts was because of this framework that we've talked about so much in here. So the market was sitting right here. My puts had lost probably half their value at that point, which is what I was expecting because I had made that much and more on the calls. And I was thinking, well, we've got a lot of resistance coming up here between this downtrend line and the top of the Fibonacci zone. And I said, and I had another 6 weeks of time on the call options. I was like, well, let's just let it ride and see what happens. And man, did it just crater. It dropped over 3% from the Fed announcement on down into the close. And I actually closed them right near the end of the session, about 10 minutes before the end of the day, I closed them. So I'm not, I don't fancy myself as a day trader, but accidentally day traded those couple days, and then would have been happily rewarded had I held them. I'd have got another probably 100% return on those call options, but I didn't. I did own some inverse ETFs on the Dow because I thought it had been so overextended, and I exited those right at the Fibonacci confluence zone. So now I'm sitting here, and we need to develop a go-forward plan. And I've talked so much, I don't want to lay out the whole plan. I'm happy to come back to it. But I'm almost thinking this is a bit of a bottom for now, and would not be surprised if we saw price action come back up and test this Fed range in here, which is a great segue to my friend Scott, who is an expert and a genius on Fed boxes. So, Scott, I'm going to hand this over to you after that massive introduction.
Hey, great work, by the way. That chart looks good. All right, so let's talk about the Fed and get you kind of set up with the Fed boxes now. So the way this works, if you're new to this concept, and this is something we talked about back during the boot camp classes and the webinars at TSU, what I'm looking at here, guys, is the Federal Reserve announcements, and the ones you see that are marked in the magenta, pinky-looking little color here are all the Fed rate hikes I had marked to this point. And you got a new one yesterday. So they hiked, 75 basis points and all that. So now that you know that, all I've done is go pick your time frame. You're going to mark the high and low of a day. So that's what you see right here with the yellow lines. So I marked yesterday's high and low. Now, granted, we've gapped down. Well, if you look closely to where we've gapped into this morning, that's a prior Fed box. So these act as great support resistance. If you've seen this already, you kind of know where this is going. If you're new to this, I would suggest you spend some time marking this. Everybody's always asking, where are the smart money, big boy, big girls, and all those, playing with? Who's bigger than the Fed? No one. So at the end of the day, if you're really trying to figure out what's going in the market, and I continue to demonstrate this almost daily with the Trader Traction Group and Traction Pro, and we actually looked this morning live for 2 hours, we talked about this. You could do this with any stock, any symbol, any market, crude oil, sugar, lumber future, whatever you're going to look at, because that's ultimately what people are going to tether to in the marketplace. So you can see this morning's gap is into a prior Fed box, and it's just hanging out. This is awfully too steep on the way down. If you're around me, we talk about slope exhaustively, because people don't understand slope impacts your ability for what your stock can and can't do after that. So this is kind of where we're sitting. There is an unfilled gap here. We can all see that. But when I'm standing back and looking at this, I now have the most current Fed box marked, and that's going to be between the arrows. All it is yesterday's high and low. That's it. And you get this every so often, and they're going to announce. And on my other charts, you'll see it marked as a purpley looking, fuchsia colored box. And that gives me support resistance going forward. So it'll be interesting to see if we can go back and retap and fill the gap and all that. But once we get to that level and pay attention to it, one more thing to add here. The way I look at the Federal Reserve boxes, just so you get a feel of this, inside of the box, I'm going to have a neutral bias, if you will. Below it, more bearish, and above it, more bullish, if you will, so to speak, to use common terms. But it doesn't mean if I'm inside that box, I may not have a bias where I think we're going to go directionally. I think for a lot of you, if you're going to use this concept, what you will find is, especially if you're a longer term position trader, investor, what have you, you can use this to help bias. There's a whole logic of how I look at this to call reversals in the market as well. We're not getting to that today, but it's a longer term layout. But for a lot of you, if you're looking for short-term support resistance levels, you'll be amazed when you look at these levels how well they really do work. And when you're trying to target certain places, why you may want to start looking at this. This is not a new concept for me. I've talked about this, I guess, off and on for the past 2 decades. But with TSU Group, I've tried to make this clear visibly for people to see this. And it really does add value for people if they get used to using it. So it's just a matter if it works for each of you. Whether you day trade or you invest, there's value. So for what it's worth. Back to you, Josh.
Scott, where's a good place to find all of the dates for the FOMC meeting releases? Like I found one here. I'll put this in the
Federal
chat.
Reserve. The Federal Reserve has the data. Like you can go to the Federal Reserve's website and they have it all. Then there's some people who've done some free stuff, and this will bring up one quick note with that. I've been asked, would you mark all the boxes? Well, I have them marked back to 2017 currently on one chart. The thing I think most people care more about was there's basically three stages. They either cut, they hiked, or they did nothing. They maintained, right? They didn't make a decision. They just maintained whatever the current situation was. So they didn't really make a decision. There are a couple websites out there that if you go back, you'll find that will show you, for years going back where they have hiked or where they have kind of cut in the past. That also brings up if the Fed, like during COVID, let's try this really quick. During COVID, is it on this one or not? Yeah, we had like 3 emergency meetings during COVID, if memory serves me right. That's what these are. And this is one of them right here. And of course, that led to a really big inflection in the market. But that's also going back to the 2017 Fed back over here. So if you wanted to limit the amount of data on your screen, then look at the ones where they actually have hiked or cut. And the most recent ones being hikes, I've covered these to be more reddish, more almost a bearish type mentality, if you will. If I was color coding the others, I would have them more green if they were cutting, because typically the market appreciates that from a value. And if they did nothing, I would make them yellow or more neutral for what it's worth. You guys want to see the market. If you want to get more into the bullish mindset and just use Fed data, skip any other technical analysis we could do, any other analysis period. Guys, you really want to start to close through these boxes. If we start closing through where they started hiking originally, then that means the market at that point has probably factored in what it needs to factor to continue to move forward for what it's worth. One thing while I've got this, before we get back to Josh, I've talked with the traction groups. You got a low over here, an obvious bigger low, key reversal bar here. And one of the things I've talked about with them is the idea of getting another pullback along the way, trying to create more of a, inverted kind of head and shoulders feel, something that gives you a shoulder on this side of it. We will have to see how this plays out. Statistically, you're in the strongest 6 months of the year until we get to sell and may go away, and we'll see how this all plays out. But right now, we're holding around a Fed box zone, and we'll see what they do with it. It is awfully steep coming back on the slope. This thing I addressed live this morning. A lot of your stocks just too far, too fast on the way back down. They need to go to the right and work off some of the slope and see how these fibs hold through here and these Fed boxes and all that. Which brings up one thing before I give you to Josh. Guys, when you see Josh is showing you an inflection point with fibs, and then you see a Federal Reserve box level right there with it, you now have confluence, like holding hands. You have price reacting to two different levels that we know have value that we can see on the chart. Don't disrespect it. Don't ignore it is a better way to say that. Don't let you disrespect it. Just don't ignore it. It's right there. They're like, look, look at me, stop sign. Oh, don't run that, right? Pay attention to it. It doesn't mean you're going to execute a trade. It doesn't mean that you won't, but just pay attention, have respect for it. Okay, it would be a mistake not to. Does that help, Josh?
Yeah. So I put this link in the chat pane, and the way this works is it's the second day of the meeting is when the reports come out. So we just finished November 2nd was yesterday. That's when the information was released, and that's when the market reaction is going to happen. So this is actually, I don't know what I was looking at before, but this is pretty straight and forward. FederalReserve.gov monetary policy / FOMC calendars.htm. There you go. This was an interesting site too. This just showed you what the rate hikes were, and we can relive the glory days where the Fed funds rate was 0%, and then we started hiking up, and up. So this is a pretty parabolic and consistent curve. I don't know that there's a lot of new information in there, but it's interesting. And everybody who missed their home refinance back in 21, early 22 is kicking themselves now.
Aren't you glad your home is sold?
Oh, dude. We were just talking about that yesterday. I mean, we top ticked that sucker too. Like I checked it on Zillow and it's already dropped down 100,000 from where we sold it at. So
Yep.
that was just the Lord's favor. And I kind of wish, I go back and forth. Like I don't have a mortgage at all right now, but part of me is kind of wishing that I had locked in a mortgage when interest rates were cheap, because I have this like FOMO, like, well, what if I do need a mortgage? Like now I'm going to have to pay 7% on my mortgage. But I'm like, I like the no mortgage life better than the paying 7% life.
You just go hang on before you jump. If anybody ever gets bored, and I mean, you're just bored out of your gourd one day and you want some interesting reading that will put you to sleep, go back to if you go through the FOMC site, you can go back to the very first Federal Reserve meeting and the write-up, and it's dry as it gets. But if you guys are just bored one day to look how things were in the 1930s, it's and the numbers. Anyway, if y'all get bored, do that one day. I've done it, and I'll probably never do it again, but it's bizarre to see how things are written up. I mean,
Yeah.
It really is when you go that far back. Anyway, moving on. Sorry.
Well, what's a little less boring than that, and I do encourage entrepreneurs and any business owner to do this, is to go and read the earnings reports of some of your favorite companies, bigger companies. Those are not boring, and it's half the time it's like a lesson in business economics, especially if it's written by Warren Buffett. I doubt he writes his own reports now. I'm sure he reads them, from what I know of Warren Buffett, and approves them. But those are some of the best financial lessons I've ever learned, and they're free. You can just read them online. It's like getting a master's degree in finance and accounting. They're very, very good. So, and a lot of people don't think to look there or read them or look at them, but they're very interesting. So let's kind of pause here in today's show, and I want to answer the questions that are on y'all's mind. And Scott and I kind of come in and we're like a bull in a china shop because we're doing our thing and we're trading, and it's hard to shift that gears midday sometimes. But I want to know what questions you guys have. What stocks are y'all looking at? Let's do some community analysis here. Go ahead and type it in the chat pane. It takes about 2 or 3 seconds to make a round trip back to me by the time you type it in. So if we don't acknowledge it immediately, don't lose heart. We'll get to it when it makes its way through the interweb and gets to us here. One that I was looking at earlier, and I'm not as wild about this now, but we can check it out. The airline industry is just hammered with multiple bogeys because they've got the rising fuel costs. And I don't know if y'all been tracking this, or Scott, if you've got any insider scoops, because you always have friends that surprise me. It's not surprising that you have friends. The type of friends you have surprise me. But, if you can believe what you read, there's an issue with a shortage of diesel fuel. And what I do know for a fact is diesel fuel and jet fuel is the same thing. Jet fuel goes through one extra kind of purification process, but Jet A and diesel fuel that you put in your car are the same exact things. So that's a problem for the airlines. Now, let's not blow the problem out of proportion. I promise you the airlines are trading gasoline futures, oil futures, and they're playing 3D chess when we're playing checkers here. And candidly, I don't know how all that works. I don't think they're going to run out of fuel in the airlines necessarily, but all I'm saying is diesel running out is not good. Also, rising interest rates. I did a little research project probably about a year ago when interest rates were starting to go up. And I realized many of the airlines rely on debt, abnormally so compared to other companies, for operations. Other companies like Home Depot and big retail stores that have to stock things, a lot of times they operate with debt too, because they buy their merchandise, their inventory on debt, and then they sell it and it repays the debt. And it's just this revolving, what's the term? It's not revolving line of credit, but it's like an operating line of credit. You spend it, you pay it back. You spend it, you pay it back. And with the rising interest rates, my back of the napkin hypothesis here is like, hey, their cost of doing business is getting more expensive. The diesel fuel is running out and getting more expensive. This probably does not bode well for people that are interested in investing in the airlines. And so I could see people starting to sell off their stock. And you've got this mother of all downtrends with the aviation industry as a whole. So ticker symbol JETS, JETS, is an ETF on the airline industry. We could look up, let's just Google ETF JETS. What's that called? Let's see where we go here. Yahoo will bring it up. Holdings, I guess. This might be in it. Trying to find out, maybe MarketWatch, find out what's in JETS Holdings. That's the word I was looking for. Good night. I don't want to subscribe. Just give me free stuff. Says everybody. All right. So you got American Airlines is 10%. Delta is 10%. United is 10%. Southwest is 9%. So that's the big boys. Those represent about 50%. And then, the rest of these are 2 and 3%. Air Canada, Alaska Air, Hawaiian, JetBlue. That's interesting. I haven't thought of JetBlue in ages. I kind of forgot they existed. Anyway, you guys can read that. Frontier. I have flown Frontier a few times because they go out west to Wyoming, where I enjoy going. So, this is not a technical setup. This is just it's more of a fundamental setup, more of like a hunch, just being wise here. If we do some technical analysis on this, of course, the simple moving average trending on bearish, exponential moving averages are slightly bullish right now. So something to keep in mind. Let's see where the oscillators are sitting. Look at this. Stochastic over 80 crossing down. And this is where I love to get into the school of common sense. Let's look at the last times that stochastic got up over 80 and started crossing down on JETS. All right, I'm trying to mark all these and not cherry pick anything here. This one wasn't quite as exciting. These lines may not be perfectly vertical either, so use the crosshairs on your own. All right, either one of these, whether we got in here a little early, sat through a retracement. Kind of see where I'm going with that? Where are we at right now? So, if I was still bearish on the overall market and I was looking for something bearish to trade, JETS might be an ETF that you want to take a look at. Let's see if there's any concerning things with divergence. MACD. All right, well, this ruins everything. See what happens, Scott, when you try to do trade ideas on the fly? That's a problem. Now, there's your problem. That's bullish divergence, friends. The likelihood that this would kind of roll down before it heads back up is pretty good. So depending on your speed of trade desired, you might be able to still squeeze out another rotation on this, but you're making higher lows on MACD and lower lows on the price action. That's bullish divergence all day long. Let's see if it's agreed upon with the... Now, RSI and stochastic don't have divergence, but MACD definitely did have divergence on it. So there you have it. I tried. What stocks do you guys want to look at? As soon as I said, what questions do you have? 3 people left. Like, boom, gone. Like, ha! Maybe they were just looking for the market update and they're out of here. Oh, this is something I wanted to point out too. Deep Sky I've got pulled up here. This is the artificial intelligence that we use here at TradeSmart University. And it's interesting. It's forecasting a higher S&P and a higher NASDAQ today and tomorrow, Friday. But then a week out, it starts to soften. And then on the S&P, it's actually forecasting lower again. The Dow, it's forecasting lower overall, which makes sense because the Dow's been overextended compared to the S&P. This is the S&P versus the Dow. You can see just meteoric price action for the last month on the Dow and pulling back. Now, look at this. This is interesting. Ironically, the Dow is still being very strong. It's borderline positive. Yeah, it's positive by 5 cents. The S&P getting a little bit closer, trying to push its way on up. I would not be surprised to see that gap close and to see the S&P push on up there. Scott, you feel free to interrupt me anytime. Simple moving averages are bearish. Expos are bearish to sideways, so none of that is helping. And stochastic crossing down 380, so all that is very bearish.
You had requests for TQQQ to look at it.
Oh, cool. Let me... oops, I almost banned you, whoever that is. MLK. I love that, putting the questions on the screen. See, that's why you should write in your questions if for no other reason than to be on the screen. Well, from the technicals, it's hard to be bullish on SPY right now, candidly speaking. My hunch is we've got a little bit more bullishness ahead of us with a hammer sitting here right at support, and not just fibs, but also the Fed support that Scott was talking about from previous as well. So I don't know, do with that what you may. Let me go over to TQQQ. Is that a leveraged ETF on the Qs?
Mm-hmm.
Ultra Pro. Is that a 2X? What is that? Oh, this is an inverse. Let me see what this is. It's got to be an inverse. I don't know if it's leveraged. Don't know that it matters.
It's an Ultra Pro, so
3X leveraged. Okay. Yep. So for starters, on leveraged ETFs, I'm a fan with asterisks. You've got to be careful about long-term trades with leveraged ETFs because there's slippage. And basically, they tend to go against you faster. So in this case, it's going to tend to go up more than it's going to go down. And you can Google, I think it's called slippage. I don't know if you're familiar with that, Scott. And I need to think through, maybe when Scott talks for a minute, I can think through the math about why that works. But there's something about that transposition from 1x to 3x that it tends to go against you faster. Ish. So, over a couple days, a week, not a big deal. If you were trading it for like a year or 2 years and trying to double down on movement of the S&P or the Qs like this, then it could be something that's a factor, a concern. So I'm going to actually look at the Qs first, and then we'll come over to the leveraged inverse on this. So it's not inverse. That makes sense. It seemed like it was super bearish, but I guess, yeah, we've been super bearish, so that makes sense. Somebody's going to correct me on that. So I'll start with analyzing the Qs, then we'll transpose this on over. That trend line obviously busted. Let me just do my vibe here, and then we'll get Scott's. I'm finding a best fit in here. That looks pretty good to me. I don't like that blue. There's my blue. I don't love that the head and shoulders pattern kicked out up there. So what I might do is just a little line to remind myself that that's a factor. But I think the angle is what we've got determined on the screen here. Make this smaller too. And then let's see if this coincides with the downside here. I'd say the best fit is right about there. And then, as you probably saw on my SPY chart earlier, I've got a midpoint that's right about there. The midpoint. And I'm just looking for a best fit. It's a little outside of spec here, but this is a nice resistance. Oops, this is a nice resistance. This is a nice resistance. This was a nice support, if I could draw, right there. We kind of wrote it down. And we're sitting right there at that support line as we speak. Going from charting to the technicals, obviously in a downtrend, obviously exponential moving averages are trending down. Let's see if there's any divergence showing up. Stochastic just rocketing lower. This is interesting. This is long-term divergence on the Qs. Right there. You see that? So we're making lower lows, barely. But it is divergence. Also some divergence here. Need to click the Save Tool button. I'm going to delete this because there's too many dotted lines on the screen, but making lower lows on price, higher lows on stochastic. I'll leave the line on stochastic just to remind us of what's up. What else? Bollinger's. The last thing we'll take a look at here is some fibs. I'll start with this candle because that worked really well on... Ooh, that looks really good. Tell you what, these two candlesticks... Let me check this. Because this is what S&P was working well with. I think I like that better. It also coincides with the same dates of the S&P. I'm looking at the top of this candlestick here, the black one, the bottom of this white candlestick here. You know, other than one day that poked its head above and closed, this is pretty good. So that would be our red box. This is good because I need to do a workup on the Qs anyway. So whoever asked this, whatever your real name is, I appreciate it. And then we've got the green box we need to do. The fibs are going to be backwards. I realize that, but let's go with it for now.
I'm rubbing off on you.
Yeah, shut up.
It's your doom, dude.
I'm doomed.
You're doomed.
I get angry about backwards fibs.
Yes, I know.
That sounds like a me problem. So this is interesting. We're actually through the fib zone here. We could try a more conservative one by coming. No, we can't. That was the most conservative we could do. I actually meant to draw this one. No, I drew it correctly. I'm wishy-washy, back and forth. So how do we deal with this? I probably wouldn't. If I was forced to pick a direction, I would say the weight of the evidence approach suggests there's more bullishness than bearishness on the Qs right now. It's not as much as it used to be, but the Qs are more heavily favored in the tech sector. And I know the tech sector is getting crushed right now with interest rates, supply chain issues. It's just not been great for technology. And that could be pushing the Qs down a little bit more. I think if I was going to take a bullish trade, something is definitely more bullish than the Dow is certainly more bullish or acting more bullish than the Qs are right now. And Scott could speak to that divergence a little bit because he's got some good thoughts on that he shared. But I would not go bearish on the Qs. I think there's too many hurdles to get through right now to go bearish. I think there was one more thing I wanted to see here. The Qs are forecast. This is interesting. Look at this. The Qs are actually forecasted very bullish on the AI. So take that for what it's worth as well. Scott, I had something else to say, but I forget what it is. So I'll let you kind of comment on this.
Yeah. So what's crossing my mind is, like you just said, Josh, is let this pull, let it get to where it's supposed to get to. Let it settle out for a little bit. You don't have to force anything right now, guys. You can let it set up and come to you. I'm a big, I've done so much of slope work. When I look at stuff like this, even the way he has it marked up, it gets my attention. But I do want to show you guys really quick on Goldman. I just want to draw this out. We've had a screaming, run here. You're on your fourth wave up on Goldman Sachs on that daily. But I want to show you something that's getting my attention with this longer term. And this fits with kind of what we're talking about a little bit because of where things are going. Okay, so you're in the strongest 6 months of the year officially in November.
Mm-hmm.
Okay. And if you look at this, there's your 50% retracement of Goldman Sachs from the 2020 low back, down there into the 21 high or whatever it was. And you can see where it's found support where it should. What's interesting is the ricochet bounce right here. And you are getting a little higher or low. We're going to have to figure this out, what it does with this. Again, this thing's super stretched, guys. I, longer term, would not take my eye off the ball off of this one. In Traction Pro, we went a couple hours today live, and I walked through some different things. And I mentioned Goldman, I guess like the tail end, but I'm bringing this up for a reason. It's not just Goldman Sachs. What I think, and this is much more longer term for some of you, so Goldman is more near term, but I want to make something really clear, everybody. People around me for the past few years will tell you, like when I teach people how to do shadows, I will beg people who have gone through Traction, I even said it in Pro this morning, please take the time to mark up your long-term shadows on a weekly chart if you're an investor or you're looking for an inflection point in the market. Now I'm saying the same thing with the Dixie. I'm saying it with all your commodity stocks. I am not coming on air live today and telling you that something's about to happen with that. But what is amazing is how many times, and I've shown several examples of this with NVIDIA and how much it's gotten destroyed and how people can see certain levels and know when to start paying attention to and really start looking for the opportunity, like Livermore would say, the money is made in waiting. Well, Goldman in the near term, and I say near term, I don't mean the next 20 seconds, I would not take my eye off this weekly longer term. And this is where a lot of traders get in trouble. You're jumping around and then the trade happens and then you miss it. I mean, I'm guilty of this as well in my career plenty of times, guys. So I'm not preaching at you guys on this. I'm trying to tell you don't make mistakes I've made. And we probably could all raise our hand and say we've done this. Don't be that trader. Again, you can mark levels to alert you on your stock. This is trying to set up something that is very constructive technically on the charts. And again, if it does go up 50% or retraces half of this last leg down somewhere in here, that's all nice and cool. That's not what I'm focused on. I see more of what's attempting to create a structurally strong pattern here and a rate rising environment, which eventually should benefit, some aspect of all of this, but we'll have to wait and see. I'm not making a macro call, but if I'm going to take from this weekly chart or a shorter term chart and tell y'all, it's going to be amazing. You're going to see it just like you saw with technology. All these tech stocks that have gotten tech wrecked, right? You're going to see the same thing happen down the road, whether it's in 3 years from now or in 6 months now or whatever it's going to be with commodity names. The dollar. I'm not anti any of these. I'm trying to tell you, let the patterns develop. And when they do, if you're a longer term player in the market, you're going to have some incredible trades that are go completely other direction of what we've been doing. And I stress this, and there are people that are listening live right now that can tell you I've stressed this for the past couple of years to people. skip whenever the market was going to correct and crash. It's just doing the prep work. You see Josh do this every time we go live on YouTube. He shows you his charts, with the fibs and how he's looking at it. If you're patient, let trades come to you. And to me, I think this is important enough for me to, interrupt what we're doing to stress it to you, because I saw people miss a lot of opportunity in the past couple of years, both longs and shorts, because you're so busy trying to do something right now. When the trades show up, you're distracted. If you're in that camp and you can and that resonates with you, I would really suggest you rethink what is your, like pilots, you guys got a checklist that you go through before you fly the plane. In my past ex-father-in-law, before he passed away, he ran over, long hauls over the road and all that. He had to inspect his truck for DOT reasons before he drove the truck. And it's the same thing here. Set up your plan and execute your plan. And if it's not ready to go yet, find something that is, but don't take your eye off the ball. Beat this and it be senseless, because I've watched people miss so much opportunity. And I'm saying it right now with Goldman Sachs. It's not where I want it to be on a more long term yet. But if it is, then the opportunity may present, just because the way this is behaving. We will let price. I don't know if Sorties is in here right now or not, but Sorties and I have talked about this in Traction. Sorties said, well, what do you think when it gets here? And I'd say, Sorties, once it gets there to that level, I will make a decision. And so that's what I'm telling all of you, because Sorties normally in here with us. When the price gets to its point of inflection, that's when you get a little more drilled down into it, and that's where your other tools that you learn through TSU come into play to help you execute that. So sorry to go on and on about this, but I've watched a lot of people. I've watched a person miss 221 points straight up legit out of Facebook Meta back in the day because of exactly what I'm hammering right now. And it's just, they knew they wanted to trade it, and then life got in the way. So try not to fall in that position. So sorry to go so long-winded.
No, it's great. I wanted to come back to Chapo, which is the best name in the world. Yes. And talk about IWM, which is small caps, the ETF on small cap stocks. And there's a good illustration point in here. And then I'm going to freelance for a minute, because I'm always learning too. I'm learning new stuff. And I've just kind of been playing around with some things. And maybe, Scott, you've got more experience because you're a lot smarter and got more longevity in the market than I do. But this is, let me first highlight here before we jump into it. There's an interesting W pattern that's happening here on IWM. And if you blink, you might miss it, right? Let's put it on a line chart and see if you all can see it better there. You'll see that W pattern literally looks like a W. And I just learned this recently as well. I somehow missed this in my technical analysis travels, but I think, Scott, you'll resonate with this if you probably didn't invent it yourself. I think half the stuff on Investopedia is just Scott's diary, and he started a Dear Journal, and they published it as Investopedia. So anyway, there's a theory here, and it's pretty cool, that the size of the W is equal to the size of the breakout. And probably my drawing is a little bit off here. Let's see if we can tighten this up. And it's pretty close. There we go. Let's see if that's better. I'm just going for best fit, grabbing the highs in here, trying not to rush it. That's pretty good. And then down here, catching most of those. It might be a little bit high. But picking it up and seeing the breakout of the W is about where we go, maybe just a little bit above. So from that perspective, I think the pullback makes sense. Now, what's interesting is this could be, and I'm not ready to call it yet. I will when I get confidence. But we could start seeing the market bottoming, and this would kind of be a textbook bottom. Please don't run out of here and say Josh at TradeSmart University said the market has bottomed. But to Scott's point, we're going into the strongest 3 months of the year, 2 months, November, December. Not that you can't crash going into the new year. Go back and look at 2019. Was that the year, Scott? 2019 crash, or 18 going into 19?
I think it was 18 going to 19, if I remember correctly. I can look at that, but yeah.
I'll check it in a second. So the market can crash. That was a significant crash going into the new year. But this would be indicative of a reversal. We had the breakout, the W pattern, the breakout. The breakout matches geometrically. We came back to support, and now we're trying to go up. I'll also say, as a point of bragging here, we're just positive on the day, 34 cents. And IWM for Deep Sky is positive on the day. So that's good. Now, Deep Sky is forecasting lower 1, 2, and 3 weeks out. So we got to keep that in mind as well. But that lower could mean it's just lower from where yesterday is. So, a move like this would still be lower. If we have a couple head fakes in through here, we'll have to see. So that kind of caught my attention. And then I also was looking, if we go out of fractal, like, well, this is actually kind of starting to be a W pattern as well. Maybe not quite completed yet. That's an ugly W. Hold on. There we go. So, we maybe not completed. This is where the breakout would be, but then a push up and then a come back. And like, where I'm going with this is that behavior
Hey,
feels
Josh, I don't
like
think your screen's showing. Sorry, I don't think your screen's showing. I just
oh
realized
gosh.
looking
Yeah,
outside.
that's because you have a delay.
Sorry.
I am so sorry about that, everybody that missed it. Let me draw this again for you. That's a rookie mistake. Yeah, I was looking at it the whole time. I was like, that's weird that Scott's screen is still showing. All right, so coming back, we looked at the line chart. I'll recap it quickly. Here is the W bottom, or W pattern. I don't know if it's the bottom yet. And I said there's an interesting theory out there that says, let's see if we can kind of grab a best fit with these candlesticks. Maybe a little bit outside of that. That's pretty close though. And if we just copy and paste the box, geometric analysis, as Scott says, the theory is the size of the breakout corresponds to the size of the W. And then what often happens is we come back and we test the top of the W as support, old resistance is new support, and we would continue on. That is starting to look like a bottoming pattern. That's number one. So we're going to treat this like court. That's my first argument. My second argument is if we jump out of fractal, you're starting to see another W pattern beginning, which is a fancy way of saying a double bottom is basically what this is. So if that were to be true, given November, December, right? So here's 2023, kind of keep advancing on. That could be about where, we come back to, and then the market needs to make a decision. Now, some of the election results could have an impact. By the way, if you see a split government, that tends to be seen in favor by the stock market. So if the Republicans take the House and the Democrats keep the Senate, or the Republicans take the House and the Senate, but we keep a Democrat president, that's going to be seen as gridlock, and the stock market likes gridlock. Just stop screwing with the rules and let us do business for 2 years until we go through this fiasco again. So there's the two W patterns. And then also, I mentioned it a moment ago, we're starting to get a support, a double bottom here. Boom. Big bottom. Again, don't run out of here. Say Josh is forecasting a bottom on small cap stocks, but it's starting to feel bottom-y. And if we look at this in conjunction, and let me see if I have it here. I've talked a lot today, Scott. I don't know what's wrong with me.
You're good. You're good.
I just have a lot to say, apparently. Where did I do this? Was it on the Dow? Was it on... I marked all of the previous recessions. Oh, we're on that right now. DJI.
Something else you have marked on that people need to be paying attention to on your IWM chart was that high side yellow channel line coming down, because it's come back in to retest that slope and move sideways to consolidate after that. No, we're just not going back inside a previous trend or previous angle or previous momentum. So you've had a break in the momentum, which is important with what you're explaining your body.
I didn't track that because I wasn't paying attention, but I'll go
You're
back and
okay.
let you re-say it in a second here. Let me see if I can fit this on weekly because it's so crammed with monthly.
Mm-hmm.
So here's all of the recessions going back to 1981. The red box is the recession. Now, as we all became aware of because of the news media, there's kind of two ways to look at the recession. You got the two consecutive periods of GDP decline as the conventional way of defining a recession, and then you've got the neighbor methodology that they used to define the recession. I think this was the latter that I used. I don't candidly remember. Um, I just found list of U.S. recessions. It was on Fred, FRED.com, the Fred data. So whatever they use is what I used here to mark all these. And going back to the 80s, but let's pick one here. This was the double dip recession in 2001, 2002. That was a tough one. But let's just grab this. I don't want to move it. I just want to duplicate it. Come over. And if I just put this about where the recession started, do you see what we're kind of coming to the end to here? And this is, an average size recession where the market was selling off. Now, again, we did get a little bit of a bounce here. If we zoom way in on that, it just was short lived and the market said, nee, and we came on back down for another one. But generally speaking, the recessions are lasting about this long, which puts us into, well, I guess in this case, July of 23. So a little bit further out there. I was thinking it was going to be closer than that. My point is, I've taken the worst case scenario. Some of these recessions, like the flash crash of the COVID world, probably going to get banned from YouTube for saying that. There's a time factor in here that we're running out of time, for the market to just keep going lower and lower and lower. So if we go back to IWM, looking, we were kind of projecting out. Maybe we come up to the top of this big W pattern. We start getting in here. Even July, that's about where that box fell. Pull back. Time and price action and everything is kind of starting to line up for me to say, okay, yeah, maybe this is starting to form the bottom right there. What were you saying, Scott, that I missed?
Extend the yellow top side of that channel out. Your yellow trend line coming down the top side of a channel, extend to the right. And then you'll see where price is kissed right back to it and reversed.
So we could also probably do this. That could be a thing too. Just keep that in mind. I don't know that would freak me out necessarily because we could keep drawing those from now until Kingdom Comes, the whole way up a bullish trend. So I don't know. What are your thoughts on that, Scott? The extra.
No, you should. That's a fractal of it. This is one of the things we talk about in traction all the time. Once you have a fractal figured out, it's going to resonate into the future and you will find future support resistance and eventually it will stop. And then you've got another shift in the overall behavior. But yes, that's exactly what you should. Yes, there's nothing wrong with that. I do it all the time. The thing that I find most interesting is the middle of that, where you've come down, re-kissed that midpoint trend line, and then come up and out of it, which is positive for what you would want to see. This is what should technically happen, which is good. But yeah, your charts look great.
So one of the new things I'm playing with, and I realize we're at the top of the hour here. By the way, before everybody bolts on us, I guess we're down to not quite as many people. But if y'all like the video, it really helps us out. And we had 50 people stop by today. So we're growing every single week, Scott.
Sweet.
Do you do much with Ike and Ashi candles? Because I haven't looked at these in years, but I kind of love them because it clears out so much of the noise for trend traders.
There is, I've used them since, I don't know, early 2000s, I guess, going back over time. I only bring this up maybe 2004. I don't know, somewhere back then. I just careful, and I say careful with this, guys, on your settings with them, because I watch traders get into trouble sometimes trying to smooth these things out a bit too much. But yes, and I guess it depends on whose platform you're using as to what kind of settings you have with it. But yes, for a lot of people, these can really weed out a lot of the noise factor for people and be very constructive.
So this is beta, what I'm about to say, which is not to be confused with meta, which apparently means otherworldly. Beta as in untested. I'm learning this. I'm just enrolling you guys in my continued education and edification. But what I've started playing with is this Ikenashi candlestick where they roll over color and you get a MACD cross, and it's the MACD line crossing the smoothing line. And it works in both directions too. And so what I should state here, in case anybody's confused, Ikenashi candles are not they're not based on price as you understand it. It's price and time and an average of multiple candles, and that's why they look different. So, you wouldn't place a trade based off from, the price of an Ikenashi candle necessarily. See how different these are, and you can play around with it. But it helps weed out the noise and gives you a direction of the trend. So just, go do your own research. Look for these moving average, the MACD crosses, and just see if that would have helped you get into some of these trends. And, maybe even combining this with something like Scott's higher candle close, lower candle close, or, other tools to keep you in or get you out of the trade. Here's a pretty definitive crossover, right? And this one had a little bit of noise in it. But sometimes these are just amazing. And I'm playing around with this a little bit and seeing where it takes me. And, if you come up with something, let us know. And, I'll consider it or bring it to the YouTube show next week. We'll take a look at it and we'll all benefit and learn together. So, Scott, I don't know how I had a lot of words saved up, man.
It's good. That's
I had a lot of talking I had to do today. Get off my screen and come back to the two of us here. I feel like you're taller than me.
I am 6'7", so.
There you go. Hold on, I can fix this. I have a standing desk. There we go. I'm growing as we speak.
And I'm off the screen.
We're such dorks. Anyway, I hope you guys enjoyed the show. Scott, I'll let you wrap up with any thoughts you have and give you the last word, and we'll take it on home today.
Y'all take care. Enjoy the week ahead. Don't force trades, guys. The biggest thing, let your trades develop and come to you. See y'all next week. Bye.